Robschild. No investment advice. Welcome to the show where we view financial markets through technical analysis, macro financial history, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Tuesday, September 24th, 2024. Today's episode, we start with Oh My China. If you've been following my show, you know that I, down here, said, oh my goodness, this is coiling up really tightly, and it could break out to the downside or to the upside. And I also specifically said, I'm guessing to the upside for many reasons. This market has been very suppressed, very undervalued compared to the holdings American equivalents. KWEB basically holds the Amazon, the Facebook, the you name it, like internet tech company thing. It's in this fund. And today, and if you've also been following the show, you know that I have about 10% of my portfolio in this fund. And today was a pretty nice day for me. I've been accumulating this fund for a year or two now, and it went up by 10%. The idea here is that the Chinese central bank came out with basically stimulative plans to get the economy going. People are believing it, and so Chinese equities are just going up here. This also is in line with the idea that, as we in the United States are cutting rates as well, the value of the dollar compared to, other currencies, including in China, the value of the dollar goes down, so that helps push equity values of emerging markets forward. Now, I'm not a master chartist, but when you have a very clear downward wedge with a breakout, these things can really explode higher, as it did, but it didn't just explode higher. It really gapped higher and went higher, which means there's a lot of momentum here. There's a strong possibility of this continuing for a little while here. My original plan with KWEB regarding valuations is, I think, a more reasonable price of this fund would be around the $50 range, and that's probably when I'll be selling. Probably between $45 and $50 on KWEB. And that may come much sooner than I expected. Next on today's agenda, consumer confidence came out much lower than expected at 98.7. The expected was 104, the last 103. This, it says consumer confidence is dropping right now. I believe the recessionary number for this needs to be at 80 for 3 months in a row for it to count as recessionary. There's other things saying we're already in a recession, but this one's not quite there yet. Thursday, we have GDP coming out, the second revision of quarter two. The initial reading of this was 2.8%. The first revision of this boosted it up 0.2% to 3%. Both of these numbers are good numbers. Anything 2% or higher is a great GDP number. And so it's probably not going to be below 2%. The most of these things usually get revised are 0.2%. Now, one other thing, though, is that, typically when you're headed into a recession, these things get revised lower. And so the first revision of this was actually revised higher. It will be very notable on the second revision what happens here. This could potentially rock markets here if it ends up being weaker than people expect. Friday, we also have PCE data. This is the Fed favorite inflation gauge. This can help gauge where the market expects Fed funds futures to be, so that can push the rates around on the Fed funds futures. The next really big data drop is next Friday. Not this Friday, the following Friday, we have another unemployment rate coming out. On to the daily reminders. Sorry, but not sorry. These things are immensely important to have in your mind on a daily basis, I believe, at this point in the cycle. The 2-year, 10-year Treasury yield curve was inverted for over 2 years, reverting recently on the 6th. It's never been inverted this long, except for right before the Great Depression, suggesting we might be headed into another Great Depression. Sommerl has been triggered in July of 2024. When this happens, it says the recession has started. This is triggered by the unemployment rate going up at an unsustainable pace. Even though it's low, it's going up fast. S&P 500 PE ratio is 30 without any major earnings contraction. This is an extremely expensive, extremely dangerous market to be participating in my strong estimation. Also, the rate cutting cycle just began on the 18th of this month with a stronger than normal cut, a 50 basis point cut instead of a 25. And the Fed funds futures as of today is still pricing a 75 basis point cut more for going out to the end of the year, while the Fed is saying, no, we're only going to do 2 cuts. Well, the market says, nope, it's 3, maybe even 4 is slightly priced in still. All of this leads to my crystal ball rating. I still think that it would make sense for a market crash to be here, coming around the corner. I also believe that because of fiscal dominance, just like the hiking cycle was not strong enough, the cutting cycle will not be fast enough to save the economy on the other side of this. On to the charts, the S&P 500 is still cruising down the highway the wrong way, going 100 miles an hour on empty, closing again at an all-time high. The NASDAQ, the triple Qs, is not showing quite as much strength as the S&P 500, closing at an all-time high. Instead, we're sort of like hanging out in no man's land here, doing this little dance of little tiny candles going sideways. I mean, this market is clearly like itching to break out either to the upside or to the downside. I'm guessing to the downside. I still think that this is a head and shoulders top of the Qs based on valuations, traditional normal valuations of stocks. American stocks are very overvalued right now. It would make a lot of sense for this to go down, but I don't control Mr. Market. Sometimes Mr. Market, loses his mind, does crazy things. I think that's, if we do break out higher, be careful there, Mr. Market. Again, I don't bring this up on every show, but lately it's been important to bring it up, the VIX Futures term structure. Although the VIX itself is not very elevated, the October contract is above the November and December contract, suggesting smart money people that are dealing with futures have more fear priced in here. While a lot of markets don't show a lot of fear, this one is showing a little bit. For chart patterns, I said recently TLT looked like it might be breaking lower, but actually if you take August and September, these lows here, we're still on this line, so this could be a buyable dip. By the action that I'm seeing in the market, I think what's going on here, if you saw the pre-market this morning, TLT was much lower, and I think that may be the market trying to flush out retail investors. I think smart money is piling in here. I think I'm smart. I have 55% of my portfolio in here. I think treasury bonds are a good place to be. I mean, just take a look at the yields on China's version of treasury bonds are only at 2%, while ours are still, our 30-year bond is still at 4%. Like, there's mismatches in markets right now, with the valuation of the S&P 500 where it is, with rates this high. It's like it doesn't really equal out. TLT should do well right now, I believe, in this environment. So I'm still holding. I might, if this breaks down lower, I may actually be adding at this point, especially if I see more weaker economic data coming out that convinces me even more that we are in a recession. It's like, yeah, TLT is the place to be when, when you have bankruptcies. Right now, Jamie Dimon even came out very recently saying how the market is pricing in a soft landing, and they are. This is exactly what he's talking about. It's exactly what I've been chanting for like a month now, at least, at how credit spreads are incredibly tight. Basically, when credit spreads are tight, that's not like no big deal. That means investors are willing to pay more for lower yields on higher risk. And so the assumption is that there are going to be less and less and less potential bankruptcies in the future. That's what the market is currently pricing right now. All while the SOM rule got triggered, all while the yield curve's been inverted like crazy, all while, by the way, while the Fed is cutting rates, extra daily reminder, the Fed is still strangling the economy. We are still in restrictive rates right now. Today, the market is being strangled just a little bit less than it was a month ago. It's really important to understand all these things, and you got to ask yourself okay, so which market's wrong? Is it treasuries? Is it everything else that sees inflation? Is it the labor market that is showing weakness? Who's wrong here? At the end of the day, things need to eventually come to some kind of equilibrium. If you're following the show, you know that I've been flabbergasted at how junk bonds have been just going up and up and up. Again, this is directly saying this market, the people that are buying these junk bonds are saying, nah, they're not going to go bankrupt. They're fine. I'm perfectly fine paying more money and getting less yield for these higher risk bonds. Where we are in the cycle, I think this is very unwise. I think this is wrong here. I currently own puts on HYG. I bring it up today mostly because we are clearly in a flag. Normally, after a run up in a flag, it looks like it may break out higher somehow. Credit spreads can only get so tight before people... what? Are they going to go reverse? Are we going to pay more for junk bonds than for guaranteed treasury securities? Are the yields going to go below what you can get from the U.S. government? That's not a possibility. I would bet my life on it. But, the chart wants to go higher, it seems. I would guess that it's more likely for this to finally start breaking here. But I'm just a guy with a crystal ball. With excitement about China helping the U.S. markets get a bid here, helping the whole world economy, world markets see oh, well, that's great news. China is going to be, they're saved. The economy is saved. The world, the global economy is saved. Oil, a more real market, controlled less by Mr. Market, is not very bullish looking here. Sure, we've been floating up here recently, but today, on a day like today, if China reopening or Chinese stimulus would really lead to a larger booming economy, we should see strength here in oil, not weakness. By the way, all these hurricanes coming on, these things usually impact oil. They usually make oil go up because they have to shut down the production of some oil producers, I believe. I may be wrong on this, but with all of that going on and this China news and oil just sitting here like a sitting duck, not really doing anything today, what did we do? We went sideways. We went up by 0.6%. This is saying very clearly, no, things are actually expected to get weaker here. Same with the Fed funds futures, same with the VIX futures term structure. The markets that are controlled by smarter money, not pop stocks, not Nvidia, not Facebook, oil futures, Fed funds futures, these things are telling a very different story still today. With that said, not all commodity markets necessarily agree. one of my favorite things to keep track of is a fund COPX. This is global copper miners had a huge bid today, going up 7%. Copper is a really important market to watch. It's referred to often in financial circles as Dr. Copper because it, the world uses so much of it in electronics, car manufacturing, a lot of real stuff involves copper. And so for this to get really excited here, I mean, this one's not really agreeing with oil. This one's getting a lot more excited, obviously, about the prospect of this Chinese stimulus, boosting the world economy. Very similarly in silver, I mentioned yesterday, oh no, what happened? Okay, let's try again. I noted 2 days ago, silver broke out of this trend line here looking real bullish, and then we collapsed right back down yesterday, and then today, massive green candle. Silver going up 4.6% today. So, yeah, wow. Again, I'm not interested in silver unless it gets cheap. That's what I'm interested in. Gold as well, catching my eye today, up another percent after closing at all-time highs 3 days in a row. This has been going up and up and up. Some traders are saying that this is a spot for a pullback right now. So this could be a top in gold again. I wish gold was cheap right now, considering where we are in the business cycle. And it's at all-time highs, so I'm not going to be messing around with this market. But it is notable how we are just driving higher here. I have been holding and adding to a fund called REMX. This is where I do have my own personal metals exposure. I think that this fund, Rare Earth and Strategic Metals ETF, is very undervalued. I've mentioned on the show before, I think it's mostly focused on palladium, platinum, those types of metals. I believe they also do a lot of lithium. They do a lot of rare metals that are kind of go under most people's radar. This also got a very large pop today. I have 5%, by the way, of my own portfolio in this. I've been maintaining for a while now. I think this is the most dry powder there is in metal markets. One reason I say this is because this actual ETF started in 2010, 2011, and in those years, this is almost 15 years ago, we peaked in the value of this fund at $345 a share, and we're currently $42 a share 10 years later with inflation. So if there's any dry powder in metal markets, I think it's here. And I am happy to be along for the ride in this fund. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Stay safe out there, folks. Robschild.